A very warm welcome to Monday afternoon, 27th of Feb. Really delighted to be running and continuing on with the various FSC Outlook events, really designed to connect the financial services community together and bring a range of New Zealand expertise to the fore. So much going on, such an interesting time, but also such a difficult time for many, particularly those of us who've kind of lived through the Auckland and the broader floods and Cyclone Gabrielle, with obviously showers and thunderstorms pending as we speak. Today's conversation is a really important one, continues on our really strong engagement with the Reserve Bank of New Zealand, and delighted to have Paul Conway with us today, the Chief Economist at the RB. Off the back of last week's monetary policy statement, the MPS, really interested to hear from Paul around his and the Reserve Bank's thinking about where to from here for the New Zealand economy, interest rates, state of house prices, export, tourism, really the whole gamut of what's happening in the economy at the moment. So without further ado, I'm going to invite Paul in just a moment. But folks, two things to note. These are always as interactive as we can make them, notwithstanding the fact that we're all sitting around our own laptops or desktops. Please feel free to use the Q&A button. Paul's going to be speaking for 25 to 30 odd minutes with a really valuable slide deck. And then the back end of the conversation, we're going to have a chance to have a chat. So please feel free to ask your questions as you like. The more engaging, obviously, the better. This is on the record. We are recording this conversation, and we will be making it available post this event on our YouTube channel. Again, that's for people who want to have a second look at it, or for those who may have missed it. So without further ado, a very warm welcome to Paul Conway. I think this is Paul's first event for the FSC. So Paul, really delighted to have you with us today. And like I say, continues on the very close relationship that we've had with the Reserve Bank for a number of years now as a key regulator of our sector. So with that, I'm going to turn my camera off and I'm going to hand over and warmly welcome Paul. Kia ora.
Kia ora, Richard. Thanks. Thanks for that introduction. Really nice to be here today. Really timely, actually, to be doing this with our statement out last week, where we put up the OCR by 50 basis points. So, you know, all I really want to do today is sort of run through the economics that lies in behind that decision, talk a little bit about where to for interest rates and inflation. I'll talk a little bit about the cyclone, very early days in that space, but what that sort of might mean for monetary policy going forward. As I said, it's a great time for an update. So we've got inflation, you know, well outside of the 0 or the 1 to 3% band. It's a full-on time in the macro economy. We've got geopolitical tensions around the world are at an all-time high, and it sort of feels like it's one natural disaster after another. So it's, you know, a unique period. It's uniquely challenging. There's a lot of forced change going on around us at the moment. And I think, you know, the way that we respond to these challenges is really fundamental to how the economy is going to play out going forward. And that includes in the monetary policy space. So I'm going to talk for, 20, 25 minutes and then really keen to just sort of get a bit of a conversation going. So any questions as I'm going through, just drop them into the chat, and then Richard and I will sort of bounce off each other around those questions once I've got through these slides. So that's the Reserve Bank's mission statement, Toitu te oranga, toitu te ohanga, toitu te oranga. So it means it's all about enabling well-being and prosperity. That's what we get up to here at Te Pūtea Mātua, the Reserve Bank of New Zealand. It's a mission statement that I really love, actually, and I take it very seriously. Also important to mention that these views I'm about to give you are of the Monetary Policy Committee. That committee, which I'm a member of, sort of works on a consensus-based model. So these are the collective views of the 7 people around that table, not the views of any one person, including me. And finally, there's just a bit about what a monetary policy statement is. As I said, we dropped one last Wednesday, so we do them quarterly, and it gives our sort of readout on where we see the economy and where we see it heading, and the sort of monetary policy implications of that. All right, so let's get into an overview of what I want to cover over the next 20 minutes or so. So inflation, we really don't like inflation. It's a pay cut and a tax on your savings rolled into one. It's currently far too high. The labour market in New Zealand is incredibly tight. Our economy is up against pretty solid capacity constraints. We have excess demand in our economy and have for some time. And on the supply side of our economy, workers are in short supply, and they have been, again, for some time. They're difficult to find. And supply chains, both globally and domestically, have got themselves gummed up for various reasons. Then Russia invaded Ukraine. That put a shudder through global energy markets and global food markets. Not to mention the atrocities and war crimes associated with that invasion. But it was another global supply shock with inflation coming at us over the border. It hit a very tight labour market in New Zealand and sort of morphed into domestic inflation. Then there was a cyclone, which is another supply shock that will add to inflationary pressures going forward. And we're going to talk about all of that, and then we're going to sort of channel it into a conversation on the way forward for inflation and interest rates. All right, so let's start with inflation. Let's look the monster in the eye. It's currently 7.2%, as you can see from this chart here, which breaks it into tradables inflation. So that's the red bit there, or the pink bit there. That's inflation coming over the border. And non-tradables, that's the blue bit there. So, inflation is up for all of the reasons I just mentioned: higher energy prices, lack of labour resources, war, geopolitics, housing, you name it. Currently, a little less than half of the inflation that we're experiencing is coming at us over the border in the form of tradables goods, or tradables inflation, I should say. Now, the point I want to make here is that you can see from that graph that that's quite unusual. So tradables inflation, it's usually our friend. It's usually quite low to negative, and that's because of the impacts of globalization, a sort of global technology shock. This is all prior to COVID, of course, and favourable global demographics have all sort of conspired to keep global inflation relatively benign. But that's changed, as you can see. In the first instance, that's because of the pandemic and the associated supply shocks. But there is some talk of globalization having peaked, or at least getting more expensive going forward. Plus, a few other reasons why greater inflationary pressure could be a theme for us going forward. Now, of course, you can see from the blue line there that domestic inflationary pressures, or non-tradable inflation, has also picked up. So we're going to talk about that and what we need to do to get inflation back into that 1% to 3% target band. All right, so not only is inflation up, we call that headline inflation. It's the inflation that we experience as households, but inflation is also becoming more broad-based throughout our economy. So it's not just about relative price shocks, like the price of oil going up, for example, but prices for a lot of things have been going up over recent months. So a broad range of components within the CPI basket have been going up. Strong inflation has become relatively broad-based in our economy. So we get at this through this measure of core inflation. It sort of measures persistent inflation in the economy, and that has increased. You can see, there's a little bit of evidence there that we are at a bit of a turning point, and you're going to see that across a few of the graphs I've got coming up, some sort of early signs that the economy is slowing and that inflation is starting to decline, which is exactly what we need it to do. Let's see. I should also say there's a lot of uncertainty looking forward. There always is. but the fallout from the cyclone, sort of just adds to that uncertainty at the current point. Not only is headline inflation up and core inflation, but inflation expectations are also up, especially for inflation over the next 1, 2, and to a lesser extent 5 years. So this is a measure of what people expect inflation to be in the future. So if we expect high inflation to persist into the future, then we're more likely to push for higher wages. If we're workers or if we're a firm, we might think, we've got to increase our prices to account for that future inflation. It's really important, inflation expectations as part of that transmission channel. If people expect higher inflation in future, they're more likely to sort of act in a way that entrenches that inflation in our economy. All right, so that's inflation. Now I want to spend a little bit of time talking about how did we get there, or get here, I should say. And essentially it's about excess demand or demand exceeding supply in our economy. So in the short run, pandemic relief measures, fiscal policy was very accommodative over the pandemic. Monetary policy was also extremely accommodative, and that fueled strong consumer demand in our economy. And that demand, it outstripped the ability of our factories and our ports to respond, often because of supply problems associated with extreme weather or new outbreaks of COVID. Or whatever else has been thrown at us over the last few years. And then, of course, increases in oil, increases in grain caused by the war in Ukraine. It just sort of poured fuel on the fire, and now we're dealing with a cyclone. So let's sort of go through those components. Why has inflation been so strong? Let's start with a quick look at the labour market, because the New Zealand labour market has been running red hot. Labour market participation, so the share of the population that are actively in work or looking for work, is at record levels. Unemployment is near record lows. And with strong demand in the economy, a stretched labour market, it means worker shortages. And you can see that from this data here. Difficulties finding labour is currently the biggest issue that's limiting production across New Zealand firms. So it used to be all about orders. It used to be that firms, New Zealand businesses, were constrained by demand. So small businesses operating in small markets, kind of going, if only I could, get more orders, I could get bigger. But now it's all about, if only I could find some more workers, I could get bigger. In the past, we've grown our economy essentially by throwing workers at it, and that sort of abundant, low-cost labour, much of it coming through migration, has really been interrupted by the COVID pandemic. So a shortage of workers is currently the most important factor holding back business growth. You can see from that red line there that's, again, the signs of that turning somewhat, which sort of gives us a bit of comfort here at the central bank. It's all about labour. This is the first time I've ever sort of walked around seeing businesses only operating 3 days a week because of a shortage of labour. It's pretty acute out there at the moment. All right, so it's a good time to be a worker, and the pendulum is swinging back in favour of workers, and that is showing up with sort of solid pay rises. Not so much for people that are just sort of doing the same job in the same way. That's the LCI data on this chart here. So same job wage inflation hasn't kept pace same job wage increases haven't kept pace with CPI inflation. But once you take account of people shifting jobs or shifting employers or getting promoted or working a bit harder, that's the QES stuff here. Once you account for that, these broader measures of average earnings and incomes have been more resilient and are keeping pace with inflation and a bit more besides. So real growth in wages broadly defined has been positive. All right, so people are getting higher wages by moving between employers and potentially asking for more frequent pay increases. And we actually see that when you look at churn in the labour market, it's well elevated currently. So a lot of people changing their work situation at the moment. Now, a good question, is this inflationary? And it sort of depends if people moving around across different jobs, across different businesses, if that's increasing their productivity, then, that's a legitimate reason for an increase in your real wage. If it's just happening because they're sort of extracting a bit of power out of a tight labour market, their sort of costs are going up, so they're increasing their wages, expecting that to continue, then that is inflationary. That sort of behaviours will sort of lead to entrenched, persistent inflation in the economy, which is where the central bank, we lean against that sort of stuff in the form of higher interest rates. All right, so workers in tight supply, other supply side issues along supply chains are also playing out, but demand in the economy has been buoyant. That's the big picture. More recently, we've seen a solid bounce back in tourism. That's what this graph here is all about, and that's adding to demand pressures in the economy. So tourism has bounced back extremely strongly since we opened borders in the latter half of 2022. We've seen strong increases in visitor arrivals. It's still below pre-COVID levels, but it's increasing rapidly. All right, so indicative of high demand in our economy. So this is consumption spending per capita, this graph. And obviously you can see the effects of lockdown there. It's pretty spiky. But overall, over the last few years, the increase in consumption per person has actually been pretty strong. If you sort of just run your eye through and extrapolate through those spikes, it's been, a bit sort of up and down over COVID. And, of course, this has been fueled by a really tight labour market, so low unemployment and strong wage growth. Also government support measures in there, and also households actually saved significantly during the pandemic. So household balance sheets are in reasonably good shape, which again has been conducive to strong consumption. Now, on the other hand, sort of pushing back against all of that, house prices have fallen. Interest rates have gone up quite considerably over the last year or so, and inflation is relatively, it's far too high. But, household spending has remained stronger than anticipated. Now, is that going to last? We're picking a significant slowdown in per capita consumption as we increase interest rates. That's sort of consistent with the idea of demand in our economy slowing to be more consistent with the supply capacity of our economy. That's how we beat inflation. We sort of bring more balance to demand and supply. And the fact that we're predicting consumption to fall is a big part of sort of demand falling into line with our supply capacity. All right, now the slowdown in demand, it's not just in our projections. We are seeing signs of demand starting to soften in the New Zealand economy, which is exactly what we need. That's as anticipated. So let's take a look at construction. So this here is a graph of dwelling consents, and you can see quite clearly from the graph that it's definitely flattened out and indeed might be starting to decline a bit from a very high level. We've actually been building quite a few houses up until recent times, but our contacts in the construction industry tell us that their order books are looking a little bit scratchy, sort of out beyond the second quarter of this year, and the outlook for residential construction has declined. So we're predicting a significant hole in residential construction consistent with this consents data. I should say, the cyclone may well have changed that. Obviously, demand for residential construction took a good bump as a result of that, and we'll talk about those factors in a minute. All right, there's also early signs of slowing in the labour market. So this is a measure of job vacancies. It's actually pinged up a little bit. This is monthly data In the most recent outturn, it's pinged up a little bit, and it's still well elevated. But again, just some signs that people aren't advertising for workers to the same extent as what they have been recently. All right, so the global economy is also slowing. It's sort of responding to higher interest rates from central banks around the planet. So over the coming year, we expect to see demand for New Zealand exports reduce, so smaller export revenues in New Zealand, so global prices for New Zealand commodities, which were very strong over the pandemic. According to this data, they peaked last year and have gradually declined in recent months, given that global slowdown and given domestic supply challenges, which have obviously been exacerbated by Gabriel. So lower export prices and revenues is on the horizon. We see that this is the terms of trade, and we see that falling going forward. And again, this is consistent with that narrative of slowing demand in our economy. Global factors also helping, I guess, is the word with that regard. All right, so that's all very well and good. I just wanted to spend a few minutes, talking about the cyclone. I should say over summer, the economy unfolded broadly as we expected in our November monetary policy statement, which was quite a nice feeling for an economist over summer to have the economy broadly tracking as expected. But then, it started to rain and then it started to blow, and we had severe flooding across parts of Auckland. Then a cyclone smashed through, reaping havoc and destruction across much of the North Island to Ika Maui, which obviously is a tragedy for all of the many people directly affected by that, and it's also going to have significant economic effects. I should say it's still obviously very much early days. We were writing this monetary policy statement as the rain was coming down and atmospheric rivers were slamming into the east coast of the upper North Island. So we're sort of scratching at sort of what the impacts of this is going to be, or what the size of those effects are going to be. But it's clearly an inflationary event. It's another supply shock, yet another one. In the near term, we expect that there will be price spikes for things that have been destroyed by the cyclone, but people have to or want to replace in a hurry. So used cars is an obvious example, appliances that have been in water, furniture and furnishings. There's going to be a positive demand shock for all of those types of things. And we'll also get price spikes for things that have been destroyed by the cyclone, but the rest of us and globally want. So this is most obviously food. We've had significant crop damage. So fruit and vegetable prices are likely to experience a price spike. So this is a negative supply shock for these sorts of things. So positive demand shock, negative supply shock, they're both inflationary. So we're going to see short-term spikes in inflation, and we've added a bit of that into our projection, 0.3 percentage points over Q1 and Q2 of this year. Now, it's really important. In fact, it's fundamental that workers and businesses do not try to increase their real wages and real profits in response to these price spikes. So higher real wages and real profits, they need to be underpinned by innovation and by better productivity, by creating more value for each hour at work, not by higher costs and not by higher prices. We're all worse off as a result of this natural disaster, and trying to keep up or keep ahead of these short-term price spikes, it's only going to entrench inflation further in our economy, and it's going to lead to higher interest rates down the track as the Reserve Bank responds. Now, longer term, sort of beyond those near-term effects, obviously rebuilding after the cyclone without stoking inflation is going to be a challenge, given that our economy is severely capacity constrained at the moment. So the rebuild, it is going to increase demand for workers and for capital in cyclone-affected areas. It's going to put upward pressure on wages. and the price of capital or interest rates in those areas. And given that we've got excess demand in aggregate already, this could exacerbate or worsen demand pressures in the economy, leading to, even more inflation going forward. So I think the challenge here is, how do we divert resources? How do we divert capital and workers from areas of the country that haven't been affected by the cyclone into cyclone affected areas without sparking inflation? So, diverting resources. It sort of means ideally we'd be reducing demand in other parts of the country to free up those resources to move into and be part of the rebuild. So we don't know enough yet to sort of understand how that is going to play out. It depends on the extent of the devastation, and we're getting a much better read on that now, sort of this week and last week compared to previous weeks. We also need to know a bit more about the size of the government response, and we also need to know a bit about how the government plans on funding that response. So if the government borrows and spends that money in cyclone-affected areas, that is expansionary fiscal policy. Given we're capacity constrained at the moment, it would be inflationary, so it would contribute to higher interest rates going forward. So, higher interest rates would reduce demand, they'd reduce economic activity outside of those cyclone-affected areas, allowing those resources to flow into cyclone-affected areas. But the burden of that adjustment would be on people with mortgages, businesses with borrowings, basically anyone with a bit of debt. Another option for the government, which is what happened in Queensland in their flood a while ago, is that they could fund the rebuild through a temporary levy through the tax system. So that levy, it would, because people have got less money in their pockets, it would reduce demand outside of cyclone-affected areas and allow that diversion of resources to happen without necessarily putting upward pressure on interest rates. So in that case, the sort of burden of that adjustment would fall on whoever ends up paying the levy, through the tax system. You can sort of get it to sort of be borne by whoever the politicians like. And the third option for sort of funding the rebuild is government diverting, just sort of stopping or putting on hold projects that they've got going on in the rest of the country and diverting those resources into cyclone-affected areas. So sort of three options there. And, in reality, it could well be a mix of the three. All right. So just to finish up, I want to just talk about interest rates. Higher interest rates are still needed to cool the economy and to meet our inflation and employment objectives. So this is the official cash rate. As I said at the beginning, we put it up by 50 points last week. And we pretty much retained the same track that we had there in November, so a peak of 5.5%. From sort of the middle of this year. So a bit more work to do, but, a sense that monetary policy, we are getting there. We are having that desired contractionary effect on the economy. So given that we're starting from a position of very high inflation and a tight labour market, we expect an economic contraction. That's sort of our best estimate or best projection at the moment, notwithstanding all the uncertainty coming out of the cyclone. So, we're looking at a reasonably moderate slowdown, a sort of 1% decline in GDP from peak to trough, spread over a number of quarters from the middle of this year. And again, I can't emphasize enough that there is a lot of uncertainty around a projection like this at this time, when we're just finding out, more and more about the impacts of the cyclone. All right, just in terms of the labour market, that projection's consistent with unemployment increasing from very low levels to over 5.5%. And then just to finish, it's also consistent with inflation. It's still hanging up in there for a few quarters, and in no small part because of those inflation spikes that I talked about coming out of cyclone and then declining reasonably rapidly. And our current projection, we have inflation returning to within the 1% to 3% target band in the second half of 2024 next year, and then to 2% sort of towards the end of the projection horizon around 2025. And Richard, I think I'm going to leave it at there. Back to you. Really looking forward to a bit of Q&A, a bit of back and forth on the Prezzo. Thanks, everybody.
Paul, Kira, many thanks. That's a pretty good summary of where things are at, and thank you for the questions that are already coming through. So, folks, feel free to ask questions as we go through this to guide and drive the conversation. We've got about 28 minutes to have a chat. Paul, just perhaps kind of starting with house prices, which of course have come off a fairly big peak. What's the concern in the RB in terms of people's ability to afford as we've kind of headed up the interest rate curve? And impacts that's going to have on their overall spending? Yeah.
So house prices peaked, I think it was November 2021, and since then they've come off about 15% in aggregate. Excuse me, it's a bit more in Auckland and in Wellington, but in aggregate across the whole country it's about 15%. And I think in the MPS we put out last week, we sort of penciled in a 22% decline overall. So, a bit more to go. Again, let's see, heaps of uncertainty around that. In terms of, the effects of increasing interest rates on household balance sheets, I think from was it middle of, I'm just trying to recall the numbers, the middle of last year, in households that actually have mortgages, paying the interest on the mortgage was consuming about 9% of their disposable income. Based on current market pricing, in 12 months' time, that will increase to 22% of disposable income. So, it's a sizable chunk of income. I should stress that we've been here before. It's actually, if you look back through, the long sweep of history, or at least history that we've got economic data for, it's not that unusual to have the interest component get up to that levels. In a sense, it's monetary policy doing its work. More broadly, as I kind of said in the presentation, we think that the household balance sheet is in pretty good shape, although saying that there are areas of weakness, particularly people that bought houses, at the peak in November 2021, and had got big mortgages. Those people, there's definite signs of stress and strain in that part of the housing market. But overall, when you look at households in negative equity, so where the loan is bigger than the value of the house, it's currently around 3.5% of the whole mortgage book, so relatively low. It's sort of, Richard, it sort of makes me think of, I talked about different ways of funding the rebuild after the cyclone. If we do choose to do it through borrowing on financial markets and spending, that will be expansionary fiscal policy. It will lead to higher inflation and interest rates down the track. So then, we'd be putting more of that adjustment burden on those households that have mortgages. Now, of course, that's not the only sort of transmission channel for monetary policy. It sort of gets into rents. It affects the exchange rate. So it's, far more broader than that. But yeah, it does make you think about where in the economy is best placed to sort of absorb that burden of adjustment from the fact that we're all a bit worse off given the tragic events of the last few weeks.
Paul, just that question around mortgage stress as rates rise. And of course, we saw the dramatic rise in property prices and now the equally dramatic fall. So it really is the people that kind of overly geared and leveraged really high. You're putting that at what, about 3.5%, did you say?
That's across the whole housing market. So that wouldn't be just related to people that bought at the peak and took out big loans. I should say, we had like LVR restrictions have generally kept the quality of the housing book pretty high, which I think is one reason why we're not seeing broader kind of signs of stress in the housing market.
There is a question on that. Are there any plans to review or change the LVR settings?
Not that I'm aware of currently. Like, that doesn't go through the Monetary Policy Committee, so I'm not particularly close to those conversations. But yeah, none that I'm aware of currently.
Cool, thanks for that. Can we just segue just briefly? You raised the cyclone and who's going to pay for it. There's obviously significant spend, and obviously every day the number is getting adjusted, but a lot of that is clearly coming out of the general insurance sector, I imagine.
Yeah.
Can you just paint the picture on tight labour market, need for lots of people to come and help fix and repair? I mean, can you talk to the immigration conversation that connects to that question?
Yeah. I think it's totally legitimate to sort of, given that our labour market is so tight, to kind of ask the question, are there people that we could bring in from offshore to help with the rebuild? Particularly in the context of a natural disaster, we really want to get on and sort of, make things build back better and all that kind of stuff. And I think immigration has a legitimate role to play there. I don't see immigration as a sort of silver bullet that would just sort of fix all our labour shortages issues, that sort of excess demand in the labour market from a sort of lack of supply, because, yes, migrants bring supply capacity with them, but depending on their nature, they also tend to bring demand with them as well. So, they sort of land and, need to buy cars and need to sort of set up for a life in New Zealand. So, I think it's part of the conversation, as I said, particularly around the cyclone rebuild. But it's not a silver bullet for fixing our labour market issues. I think there's things that we could be doing, domestically. Like, we've got skill gaps in our labour market that have been there for decades. Our education, our skill system hasn't been particularly effective at addressing all of those. And I think sometimes in the past, when we have sort of run our economy on a sort of low-cost imported labour sort of growth platform, we've tended to use migration to sort of mask, those issues domestically. And we, so yes, more migration can be part of the solution to the cyclone, but we really need to sort of get our own house in order in terms of the New Zealand labour market as well.
Yeah, do you think now that borders are open, that immigration policy will soften in that regard? Not because of the response to cyclone, but just broadly, the movement of people into different markets is that partly a solution to our very tight labour market?
It could a partial. It's a part of a partial sort of solution. It's not the solution to a very tight labour market. Slowing demand in the economy is the solution to sort of bringing a bit more balance into the labour market. And things like more migration can help. We're currently forecasting migration to get back up to 20,000 people a year. So not back to where it was pre-COVID. Pre-COVID, we had population growth of 2% a year. Much of it driven by very high inward migration numbers. So it's not like we haven't tried, in the past to sort of address these issues through migration. And, nothing in economics as easy as saying, look, here's an obvious solution. Yes, it may well be part of the solution, but it depends on the nature of the migrants that sort of come and, they work hard, they earn money, and they sort of send it all back to their home country. They remit it back home. Then you're getting that supply response without that sort of extra demand, at the margin as well. So it depends on the type of it. It's a more nuanced conversation than just simply, let's open up to more migrants and all our problems will be solved. I think it's a very competitive global labour market there as well, as to whether or not people are going to turn up in the first place, no matter what we do policy-wise.
Yeah, that's the thing, isn't it? Because the anecdote, and certainly more sector anecdote, is that, borders are open, wages in other parts of the world are very competitive, and if you've been locked down for 2 or 3 years, both the ability but also the marketability of skill sets at a higher price. Young kids going to London, Australia, so on and so forth.
Yeah, that's right. I think, can I just build on that, Richard?
Sure.
New Zealand, our wages are relatively low across the OECD. We work relatively long hours per capita, and our house prices relative to income is one of the highest in the OECD. So New Zealand is a tough gig in many ways, both for locals and for migrants. We've kind of got other lifestyle factors that make us attractive, but on kind of cold hard, economic kind of well-being numbers, there's other places that you can go where you're going to get into a house and get higher sort of lifetime incomes compared to here. And all of that, or a lot of that, stems back to our productivity issues. How do we improve productivity in this economy? It's a topic for another day.
It is a topic for another day. Hey, really good question here around what differences or similarities, just back to the cyclone, do you see between the cyclone rebuild that's in place for us and the Christchurch rebuild? Any threads you can draw through that?
I like, in terms of the size, my kind of intuition at the moment is that the cyclone rebuild isn't going to be as expensive as Christchurch, but those numbers are going up by the day. I think the biggest sort of point of comparison, and it's a difference between the two of them, is that the Christchurch earthquakes, 2011, it sort of happened in the shadow of the global financial crisis. So the performance of our economy, it was pretty soggy. The labour market, unemployment was significantly higher than where it is today. So a lot of what I've been saying around the sort of factors to bear in mind as we rebuild from the cyclone, in the context of an economy that's operating beyond sort of maximum capacity, and we didn't have that back when Christchurch was shaking. And back then, I think the Reserve Bank cut the interest rate by 0.5%, sort of just off the back of it, because that was sort of the best contribution that the Reserve Bank could make then, was sort of stimulating demand. And now the best contribution that we can make is sort of to keep or to get inflation down and sort of facilitate that sort of transfer of resources into cyclone affected areas in the context of a capacity constrained environment. So it's a completely different economic environment now compared to then.
Fantastic. Hey, just a similar thread. I'll just read this question. It's reasonably complex. Question is, short-term price rises from the cyclone will add further cost of living pressures, reducing disposable incomes. Is there a risk you're underestimating the negative impacts of demand?
Yes. There's, I'm just open to any. There's massive risks around that. So that question is sort of saying, the household sector is taking a hit. So there's a risk that they sort of go in that. As households, we sort of go into our shells and stop spending in an inflationary environment. Like, I would actually, and you're right, we are, disposable income is going to take a hit from those price spikes, but we're all a bit worse off. It's just accepting that fact and kind of, sucking it up to some extent. And if the public, if workers and firms sort of look through those short-term price spikes, then the central bank gets to look through them as well, because they don't feed into generalised inflationary pressure. So we don't respond with higher interest rates. I think, it's important to say, the household sector, we've had our economy has grown. The economic growth in New Zealand over recent years has been the strongest across the OECD economy. So not only did the health response, we were caught without the bug for 18 months when the rest of the globe was sort of grappling with it. But, our economy, for better or worse, has or incomes have grown strongly. GDP's grown strongly over that period, a little too strong, which is sort of why we've got inflation. So I do think the household sector, in aggregate, and I know, there's a big distribution there, but in aggregate, and it can be dangerous looking at sort of averages. They sort of hide as much as they reveal, but there is strength there to absorb the loss of the associated with the cyclone.
Awesome, thank you. Hey, another really good question. This one on insurance. Question is, look, insurers are likely to tighten their requirements. Are you worried about the longer-term impact that this may have on credit growth, given that insurance is required by banks for lending?
Yeah, look, I think this is a huge conversation. I see, the Minister of Finance talking about managed retreat as two words that New Zealanders are going to get used to hearing over the coming years. So how we, climate change, you can kind of think about it in mitigation terms, in terms of reducing greenhouse gas emissions, and also in terms of adaptation, which is essentially about, should we be building in places that we know are prone to flood risks and are going to just get hammered going forward, given climate change. So yeah, there's a lot to consider there. I think insurance premiums, they tend to sort of blip up off the back of a natural disaster. That's sort of normal, but I think there's also going to be conversations about where we can, how do we retreat? What does that sort of mean for people that own properties in those areas where we no longer think it's advisable to live, given changes in the climate? So yeah, that's a huge conversation. Great question. The answer will be forthcoming over coming years.
Yeah, there's a lot of work going on inside the sector around climate and climate reporting and so on.
Yeah.
But yeah, I guess if Cyclone Gabrielle's taught us anything, it's not tomorrow, it's not next year, it's not in 50 years' time.
That's
it's
right.
kind of here right now.
That's right. So it's not just about how do we deal with the cyclone, how do we deal with climate change, given that these events are going to be becoming more common. It's, a bit of a wake-up call for us, I think.
Just quick segue back to tourism and your slide on the bounce back of tourism numbers.
Yep.
I mean, how bullish are you in that regard, particularly because you can't walk past some hospitality outlet that doesn't have a "we need help urgently and desperately." That kind of staffing is really front and center.
Yeah, so it's definitely been, a sort of inflation pulse as borders have reopened, coming through accommodation, food, those kind of activities related to tourism. I think numbers are currently about 70% of where they were pre-COVID, but I think the composition has changed a bit, and I think spend, sort of tourist spend per day, is getting up towards 90% of what they were pre-COVID. And again, in the context of a tourism industry, that was decimated by the pandemic and is sort of just starting, it's been growing back. It's been increasing its capacity pretty quickly. But I think it's fair to say demand is ahead of supply in that part of our economy as well. So, there's another good sort of challenge within a challenge of how do you sort of manage that growth in tourism, and, especially with China has sort of pivoted in terms of its COVID policies and is opening the border. I don't think we've seen too many Chinese tourists so far, but they'll definitely be another surge once that starts to happen.
Hey, just a real life anecdote, and with a question at the end, which is younger kids with the job squeeze. You've kind of got school students doing some of the jobs that might be countdown, checkout people, and so on. At the one end, on the other end, we're currently in the middle of the census, and a lot of the census collectors tending to be older Kiwis who might be just doing a little bit of part-time work. Are you kind of seeing the labour force kind of barbell at both ends, both the younger and at the older end, to kind of fill some of the gaps?
Yeah, I think there is definitely a bit of that going on across demographics. I should say, in New Zealand, our labour force participation is it kind of sticks out across OECD economies. Like, it's high. So older workers, it's quite normal for older New Zealanders to be in work. But I think you're right, Richard, that with demand for labour being so strong, it will be sucking some kids into the labour market. Ideally as a part-time job while they're still in education and training, and at the margin, it might also be encouraging some older New Zealanders to kind of stick with it. So yeah, I don't have that picture in my mind of what that sort of barbell would look like, but I think anecdotally we're definitely hearing stories consistent with what you're saying.
Yeah, awesome. Hey, there's a great question here just about pricing for mortgages. In the last week or so, some major banks are offering mortgage rates materially below their market-carded rates to win business. To what extent could prolonged period of mortgage price competition undermine any of your objectives, and how would the RB react?
Yeah, I guess I think that's true. I think some banks have been putting specials out that are reasonably competitive in the mortgage space. It's an important transmission channel for us. That sort of the official cash rate, the interest rate that we set, which effectively determines the interest that banks get paid for money they park at the Reserve Bank or loans they make from the Reserve Bank. So it's pretty fundamental that does flow through into interest rates that banks charge on borrowings and mortgages, and also interest rates that they pay on savings and on term deposits. We love competition in the banking sector. We think that's great. It sort of narrows, bank margins. The sort of area where we're a little bit concerned at the moment is actually more on the savings deposit side of it. So mortgages have gone up pretty predictably, given what's happened to sort of wholesale funding rates, but term deposit rates are lagging a little bit, and we sort of went to great pains last week to point that out and to make it clear that we expect term deposit rates to increase going forward. Because a contractionary monetary policy, putting interest rates, it's not just about slowing spending in the economy. It's or sort of the flip side of that is encouraging savings in the economy. If for some reason our banking sector suddenly became uber competitive and bank margins crunched in by 0.5%, which isn't going to happen. But if in the unlikely event of that happening, we can always adjust what we're doing with the policy rate. So we'll get interest rates, in the sort of retail space to where they need to be, one way or another. We're sort of always sort of assessing competitive dynamics and the effect that it's having on that transmission channel, and adjusting what we're doing with the policy rate accordingly.
I mean, I guess for investors, it's been a pretty tough old 12, 18 months with equity market sell-offs, house price sell-off, so really the only glimmer of hope is, instead of getting 0.5% on your savings, you now can pick up a 4-5% term deposit, yeah?
Yeah, absolutely. Yep, that's right. And, not to mention crypto, Richard.
What is your take on crypto?
It's for the adventurous. I think has been my take on crypto is that I think there's some really useful underlying technology in there, but we obviously saw a pretty severe bubble, and we're in the deep freeze of a crypto winter. In a way it could be sort of like the .com bust that we had at the end of the 90s, where digital internet type equities were sort of getting ahead of themselves, and we had a crash and there was a big shakeout. The Buffett thing, once the tide goes out, you can see who's swimming naked, and the really strong technologies kind of emerged from that and have kind of fueled a digital revolution. Really, it's at least conceivable that the same thing happens in the crypto space, but we're a ways from that at the moment.
Yeah, it's kind of interesting. The Reserve Bank obviously put out a consultation on the future of money. We've pretty much migrated in my lifetime from passbooks and coins and cash to basically
pay packets in a brown envelope.
Yeah, exactly. And it feels like with COVID and the cyclone, there are some places that are going, well, we can't connect to the internet, so it's kind of back to cash.
That's right. That's
cash
right.
Only.
Yeah, that's right. I think a cashless society is a ways away. And I think, once a town, say, loses that sort of means of transacting across itself, there's a big cost there in terms of social cohesion. So I think, just having cash, for that reason, and there's plenty of other good reasons for hanging on to cash for a while longer yet. So yeah, I don't think cash is going anywhere for a while.
Fantastic, Paul. Look, last few minutes, last set of questions. Really, New Zealand's place in the world and how we're kind of competing internationally. I mean, what's your sense coming out of COVID, and how are we connecting with our most important trading partners?
Yeah, oh, that's a nice question. I've got quite a view around all of this. Like pre-COVID, we've run our economy. There's kind of two poles of growth. One was a housing market where the only way was up. So we sort of traded houses among ourselves at ever increasing prices, thinking that we were creating prosperity. That seems to have come to an end, thankfully, in my personal view. And the other one was sort of strong population growth fueled by migration. And that seems to have come to an end as well, given, COVID and just changes globally. So, it sort of raises the question, what is our comparative advantage? How are we going to grow this economy? And I'm actually optimistic in this space. I sort of alluded to our productivity performance being lackluster, to say the least, earlier in the presentation. And you dig into that, and essentially it's because we're very small and we're very isolated. So, and we're not particularly well connected internationally. We kind of have this self-image of us being a sort of small trading nation down in the South Pacific. But if you look at the share of imports and exports relative to GDP across small economies, large economies don't need to trade so much because their internal markets are so sort of deep and competitive. But across similarly sized economies, our level of trade and integration into the global economy is among the lowest. And I think that kind of reflects, we're the last bus stop on the planet. So I'm really optimistic. Anything digital, this idea of kind of weightless trade, we can build digital products and sort of trade them down fiber optic cables. And all those economic geography sort of factors are less relevant in the digital space. And so much of the economy is sort of moving into that digital realm that those sort of economic handbrakes that have held us back in the past, they're less relevant. It's still an issue, but less relevant than they used to be. I also think coming out of COVID, we did remarkably well. Thank goodness for our sort of national broadband network. We all sort of had a crash course in using digital tools and technology, which again I think sets us up for a deeper integration into the global economy. And it's not just about firms, sort of the tech sector, although we've got a good tech sector. Games, all that sort of stuff makes sense from down here in New Zealand, but also kind of just regular mum and dad, small New Zealand businesses just embracing digital technology to sort of move up closer to that technological frontier. I think there's masses of potential there as well for improving our productivity and our sort of material well-being off the digital opportunity.
Fantastic. Look, that's a really interesting kind of look back, but also look forward in terms of where we'll be. My very last question, just on looking forward, if we're having this conversation in 12 months' time, I mean, what's changed? How more down the track are we in terms of all the challenges that you've placed before us today?
Yeah. It depends how we react. Today, I've always sort of been a bit skeptical about economic forecasts, and I've always sort of said, the best way to forecast the future is to create it. So what we do today will answer your question. I can pretty confidently say inflation will be significantly lower. We're very focused on that, notwithstanding the possibility for more sort of global supply shocks to come through the place. But so who knows? I think we're probably entering a period where economic volatility is going to be a bit higher than what we got used to pre-pandemic. There was sort of a couple of decades there. We'd sort of, consigned the business cycle to the dustbin of history. Inflation was low and stable, and, the macro economy was sort of less of an issue than what it has been over the last few years. And I think that's probably, going to continue. I sort of alluded it, there's lots of, I was writing over the COVID pandemic, op-eds just sort of saying, look, this is an opportunity. Let's sort of come together and think hard about how we do things and rethink how we do things, how we engage globally, what we do, how we sort of show up And, you know, I think there's lots of potential in that area if we play our cards right, if we take it. So I think the range of outcomes, you know, both 1 year down the track and 10 years down the track is very large. We could just sort of keep doing the same thing. And, you know, we'll end up in the same place, which is an economy that sort of, you know, muddles along. It's not a basket case, but it's definitely not a high performer by OECD standards. But I think there's things that we can grab onto now. And I think there's an openness there coming out the back of the pandemic for us to sort of be a little less stuck in our ways and sort of status quo bias. So, yeah, that's the path I hope we head down, Richard.
That is an awesome way to finish with a number of challenges to all of us. Paul, on behalf of all of us and the big virtual audience, a really big thank you. It is your first time on this conversation with us. We look forward to extending an invitation to do this on a regular basis because it's been amazingly insightful and rich with content. So
thanks, Richard.
If you could see a virtual applause, you would get it. For now, to everyone who tuned in, thank you for taking the time, and we'll be back on FSC Connect sometime real soon. Thanks for joining us. Bye for now.
Thanks, everybody. Ka kite.